Well, now, let's take a look at this exercise on recording the sale of property, plant, and equipment assets. So oftentimes, what will happen is we will go ahead and dispose of equipment either before the equipment or whatever type of asset it is, property, plant, and equipment asset. We'll dispose of it before the useful life that we estimated is up. And sometimes we keep it well past the original useful life, right? So here we have a situation where the company sold machinery, the original cost of which was $75,000, and they received $25,000 in cash. The machinery was 3 years old, and we're going to assume exactly 3 years old, and had been depreciated using the double declining balance method over a 5-year useful life. We do have a residual value of $5,000. Okay, so what do we need to do to actually make this journal entry? Because right now we do not have the information that we need to do so. So we want to make sure that the first thing that we do, we'll just put a little 1 right there, is to determine book value at time of sale. Time of sale, time of disposition, time of disposal, these are all synonyms, okay? So we're going to have to do a little bit of work before we can actually make this journal entry. So I think what we're going to do, let's see here now, how do I want to do this? We're going to do our work right over in this area. And so notice that we have a 5-year useful life. And because we have to depreciate this asset for 3 years to come up with the book value at the time of sale, I think it would be helpful to convert our useful life into a percentage under this double declining method. So the formula for double declining method, right, is we're going to take the depreciable base divided by the useful life. Let's see, useful life, okay, and then we're going to multiply that by 2. Now our useful life is 5 years, right? 5 years. And if we were to take 100 and divide it by 5, we come up with 20. So 1 year is 20% of a 5-year useful life. But we're using the double declining method, so this 2 converted into a decimal is going to be 40%, right? So I'm going to divide that by 100 and get 40%, okay? So I wouldn't normally do that, but I'm doing it here because we have to do this a few times. By the way, they mentioned that the residual value of the equipment or machinery is $5,000. We don't have to worry with that because we're using the double declining balance method. All right. So for year 1, I'm going to take $75,000 and I'm going to multiply that by 0.40. Okay, clean this up here a little bit. Depreciable base divided by useful life times 2, or 75,000 times 4. So watch this. I've got my 0.4 on the calculator, so I'm going to use it, and I'm going to multiply it by 75,000. And that gives me $30,000 in depreciation expense in year 1. So what I'm going to do real quick, just to show you that this is correct, is I'm going to actually use this formula instead. So I'm going to, and we should come up with the exact same number. So let's do that, and so you'll see why this is a little bit easier once we get a little bit better used to this. So our depreciable base in double declining method is initially, for the first year, is what we have in the asset. So I'm going to take 75,000, but this time I'm not going to multiply by 0.4. I'm going to divide by 5, okay, and then I'm going to multiply that by 2. So we get the same 30,000, and that's depreciation expense for year 1. However, for year 2, I'm going to subtract this 30,000 from the 45,000. I'm sorry, from the 75,000, and that's going to give me 45,000. Okay. So let me clear this out. 45,000 times 0.4 equals $18,000. Depreciation expense year 2. All right. I'm then going to, for year 3, subtract the 18,000 depreciation expense that I took in year 2 from the 45,000, and I'm going to come up with something. 27,000 times 0.4 equals $10,800. 10.8 depreciation expense year 3. Okay, so now I have everything that I need to actually make these journal entries. So I'm going to take this 27,000. I'm going to subtract from it the depreciation. I'm going to get 16.2. So book value after 3 years equals $16,200. So real quickly, let me clean this 2 up real quick. So initially, our book value was the same as our depreciable base because we hadn't depreciated anything. It was 75,000. At the end of year 1, beginning of year 2, we had a book value of 45. We took additional depreciation. At the beginning of year 3, we had a book value of 27,000. We took 10,800. So at the end of year 3, beginning of year 4, if we kept it for another day, we would have a book value of essentially $16,200, right? So we have a book value of $16,200, and we received $25,000 in cash. So this, what we're going to do, we're going to move this calculator right down here. All right. And we know that if the cash proceeds exceed the book value at the time of asset disposal, we are going to have a gain. So in this particular case, we're going to have 2 debits and 2 credits. Our first debit entry is going to be to cash for the amount received, $25,000. There it is. Now, accumulated depreciation has a normal credit balance. When we dispose of the asset, we have to take it off with a debit. So we're going to do that next. But the question is, for how much? Well, it's going to be the difference. Since we're just dealing with one asset, all we have to do is say, okay, our cost of $75,000 minus current book value equals accumulated depreciation, and I believe if we do that it will come out to $58,800. You know what? Let's not be sloppy. Let's go ahead and use the calculator. Minus 16,200 does in fact give us 58,800. Okay, so that's how much depreciation, that's how much depreciation we have accumulated, and so that has to come off the books. If we don't do that part, it'll still be on the balance sheet, and that's a problem. Okay, so we also have to get the equipment itself off, the machinery. We're going to do that with a debit, and we do that strictly for the amount paid. So we have a journal entry here that does not balance, correct? 25,000 plus the removal of the accumulated depreciation is 83,800. We have one credit to get the machinery, that's machinery is what that says, trust me, of 75,000. So we subtract that out, and we have a remaining $8,800. Okay, and we call that, I'm going to clean this up here, that's machinery, gain on disposal. Okay, not exactly lined up real well, but gain on disposal, $8,800. Okay, and now we have a journal entry that balances, and they always have to balance. Okay, so it says using the financial statement templates effects template, show how the sale of machinery affects the balance sheet and the income statement. Okay, well, very good. We can certainly we can do that. So let's see here what we've got. You know, all we have to do, right, is we just, you know, we can take all of these items that we already have up here. We don't have a financial statements effects template. All I see is some white paper here. So what I'm going to do is I'm just going to take an income statement and a balance sheet, and I'm going to go through these items one by one. Okay, so in the current asset portion of the balance sheet, we have a plus $25,000 cash. All right, and so we have taken care of this item right here. In the non-current, or we'll just call it, yeah, we'll call it non-current assets or long-term assets, whatever. It doesn't really matter. We are going to have a couple of things here. We're going to have a minus $75,000 in machinery. And we're also going to have, now keep in mind, be careful here, because this next item is a contra asset that normally has a credit balance. So we're going to have negative 58,800 in accumulated depreciation. So the machinery went down by $75,000 at historical cost, and then all of the 58,800 credit balance accumulated depreciation that we took, the contra asset, also has to go to zero. So notice up here, the way that we got there, though, was exactly the opposite. Okay, but I do want to make, if we were using one of these effects templates, it would be negative 75,000 to machinery, negative 58.8 to accumulated depreciation. And so that takes care of both of these items here. And so that leaves the only item that we have left is for the income statement. And so we would have a gain on disposal of 8,800. Let's see here, plus 8,800. And this, by the way, I kind of did this differently over here, but our gain on disposal, this is down in the other section. So this would not be, this gain here would not be up at the top of the income statement, and it certainly would not be an expense, but this would be down, if we're talking about a multiple step income statement, it would be down in the third portion down at the bottom. Now I'm putting it up close to this, but it's not a real income statement, all right? So that's all there is to it. That's what we have to do. So I hope you enjoyed this video and got something out of it.